name is Marilyn Anthony. I'm with Pear Tree Canada, and I'm coming to you today from a very sunny St. Andrews by the Sea, New Brunswick. I'm very pleased to be here today to welcome all of you to the 3 of 4 sessions with Robert Kleinman. For those of you who are joining us for the first time, or perhaps don't know Pear Tree Canada, we, for 15 years, have been bringing our Flow Through Share donation platform to philanthropists, their advisors, wealth, tax, and legal, and to the charitable sector across Canada. And we've enabled over $2 billion investment into the resource sector, and it enabled multiple jobs, thousands of jobs into northern communities, and many, many transformational gifts from philanthropists across the country. A reminder today that we are live, so there could be a lawnmower, a dog, or an interruption from either Bobby or myself, a plea of help to our producer, Laura, who's standing by to assist us. Another reminder that at the end of today's session, you'll have the opportunity to put some questions to Bobby live. And if you could please use your Q&A icon at the bottom of your screen, we'll make sure that we do our best to get the questions to Bobby. If we run out of time, Bobby will take pleasure in answering all of your questions on askbobby at peartreecanada.com online and in a more fulsome way. We encourage you also to attend all 4 sessions as they do increase, and you'll find today increase in their intensity. We're in for quite a ride today with Robert Kleinman, whom we know affectionately as Bobby. And you may know him from his career with the Jewish Community Foundation of Montreal, JCFM, likely one of the most donor-centered foundations organizations in this country, much because of Bobby's tenure there. But you may not know that he is also previously a partner of taxation with Ernst & Young. So what he brings you today as a consultant and advisor on planned giving is a culmination of those 2 careers. So without further ado, I'll turn it over to you, Bobby. Welcome.
Thank you very much. I just can't get enough. I just can't get enough. Well, okay, I think you probably can get enough. Thank you so much for coming back to these sessions. Looking at the questions we got last time, I was very excited by them because there was a lot on charitable major trust, which I was trying to emphasize. And if there's questions, that means there's interest, and I'm very happy about that. Certainly, I hope you implement that into your programs, and that may take a few months. You can do the Ask Bobby, months from now. It doesn't. We're not finished by the end of these seminars next Tuesday. You can keep on asking Bobby as we go forward. So we're ready to go. I've got another Alvin Siegel jacket ready to go. So we're okay. Now, this is a favorite topic of mine today. We're talking corporations. I'm going to leave the reason why it's a favorite until a little bit later. And the first thing we're going to do is we're going to look at the Canadian corporation and the basics. 3 slides. Probably many of you know this. It's very simple. But for those who are just a little less familiar, I just want to sort of define some of the basic names and concepts of Canadian corporations. So we can go to the slides. And we start with Canadian corporation basics. And we're going to be talking today about private companies, not public companies. Okay, private companies. And if there's a private Canadian, call it operating company, runs a shoe store, has a factory, whatever it is, the terms we use is OPCO, operating company, OPCO. So we'll use that term. Often that company has a lower tax rate than the basic high rates. So if we can say a personal high tax rates are about 50%, some provinces higher, some lower. The tax rate on operating income in Canada is lower, and even sometimes much lower, because we have something called a small business deduction, which to a certain amount of income allows you even to have a lower tax rate. So it's very much an incentive for Canadians to run businesses and companies. Okay. Now, if OPCO is owned by people are shareholders, that's one thing, but it can be owned by a company. We call it holding company, holdco. Okay, so holdco can be the parent company of opco. What's the advantage of that? Is that opco can pay out dividends to its parent company without any tax. It goes right through. So effectively, opco pays tax perhaps at a low rate and can move money to the holding company without tax. And this is a basic Canadian strategy, because to diversify, if there's excess money in opco, you move the money tax-free into holdco, where you diversify and invest in other ways. Much better than paying to an individual shareholder, let them pay 30–40% on the dividend, and with what's left, invest. Here you can have holdco investing 100% of the dollar. So there's lots and lots of holdcos. Let's go to the next slide. What happens to investment income in holdcos or Canadian companies? So if you receive a dividend from a Canadian public company like TD and RBC, BCE, et cetera, there's a tax rate on that. It's just a tax. It's not a computation of income like on our personal tax return. It's just a set tax. And that tax is refundable. So what does this mean? It means that when you in turn declare a dividend up to the shareholders, you can get that tax you pay back. Okay. We'll discuss that a little more. What about other income sources? Dividends from US public companies, that's treated like normal property income. You compute your income, your deductions, you pay tax on the balance. Interest income is also just normal income. 50% of capital gains, of course, 50% are not taxed and 50% is taxed. So all that goes into taxable income. Sorry about the noise. Hopefully it'll stop. 50% of taxable income goes into your property income. Okay. So all that, your dividends from US, interest income, your capital gains, income that's taxed at a high rate in corporations can be from 46 to 53%. It's very high rate. What is the purpose of the high rate? The finance and government says, I don't want you to pay a low rate on property income and defer tax. We want you to pay a high rate. Now we'll take some of that tax, 28% of the 53, and make it refundable to the company. Again, just like those public company taxes. So that when you declare taxable dividends, and therefore we get tax on those, we will give you back some of this tax. There's a whole system. So when you declare taxable dividends, you can get about 38% back if you've already paid these taxes. So it's a whole system. It's called integration. Integration is a concept that says, if you earn property income or income personally and pay tax at it, let's say at the 50% rate, you're left with 50 cents on the dollar. But if you own it in a company, if you do it in a company, pay tax, then declare a dividend to the shareholder. Maybe you get some of it back in the company. You're going to get a dividend tax credit in personally. Altogether, when it's all said and done, when you've paid your personal tax and you say, how much money do I have left? It should be the same 50 cents. That's integration. Earning it through a corporation or through individually should have the same result. And they have all these rules with paying tax, refundable dividend tax on hand, the amount that you could possibly get a dividend refund on our personal return, getting dividend tax credits, 2 different tax rates on dividends, depending on what the taxes you pay in the company. All that is to achieve integration, which is a Canadian concept, not an American concept. Americans are different. And some of our gift planning comes out of America, but it's based on their needs, not on ours. Americans you pay tax in your opco. The tax rate could be relatively high and not really different from personal tax rates, that you could have. So there's no deferral there of paying a low rate of tax and then keeping the money and reinvesting it. You're really paying the high rate well, just about a good high rate of tax there. And then when you pay a dividend to the individual, there's no dividend tax credits, it's just income again. So they have a different system. In fact, so much so that you want to operate through a company because of legal liability and all that. They have something called an S corporation. An S corporation is one that you work through a company, but the income from the company gets taxed on your personal tax return. Why? Because it's better from a tax point of view to pay the tax once rather than twice. There are 6 million S corporations in the United States. That's 1 for every 60 people. So that's a big thing. And of course, what that means is that donations would then come through on your personal tax return if the income gets there. So that's it. So let's go to the next slide. It's a concept we've seen before. It's very, very important. It's a capital dividend account. So we've already said 50% of capital gains are taxable in the company, but 50% are not taxable. That's a tax-free amount. Other tax-free amounts, examples are insurance proceeds on death come in tax-free to the company. When we gift marketable securities to a charity, 100% of the gain is not taxed. So 100% of the gain enters this capital dividend account. And what's the value of the capital dividend account? The company can declare a dividend and elect out of the capital dividend account, which is just a number, it's just an accumulating number that says, I elect this $50,000 dividend is a capital dividend account dividend. The recipient pays no tax on the dividend. That's a great tool. If that $50,000, if we wanted to get the individual shareholder $50,000, we would normally have to pay, say, $80,000 of dividends. And perhaps the individual would pay $30,000 of tax on the dividends and be left with $50,000. Here, the company just has to pay a $50,000 capital dividend out, not 80, paying $30,000 less of money to get the final result. So capital dividend account is very important. We've seen it before, and we're going to see it again. So why is it so important to look at the company? Okay. I've given you the clue. Well, I've compared to the United States, and I said they have a system which doesn't allow corporations to hold reinvestable assets at a cheap price. Having these holding companies, they don't have it. So wealth doesn't particularly grow in holding companies. It grows in individuals. Okay. We have these S corporations, which says donations are made personally because the income is personal. I need my donation tax credits against my income. So we accumulate wealth in companies. Of course, the shareholdings of that wealth of the companies is personal. I own 100 shares of Holdco, but Holdco's accumulating and reinvesting. It's got real estate in it. It's got marketable securities in it. It buys other businesses in it. Even when we looked at Dev and we saw someone that had a private company that got turned into a public company and it's worth tremendous amounts, all the time I've seen these people, those shares are owned through a holding company. Okay, so when they have all that wealth in the company through shares of the public company, it's that holding company that's having the action, which means that we have a lot of donations coming from companies, and we've seen some data which shows are Canadians as generous as Americans, and they say no, they aren't, because they only look at personal tax returns in doing the analysis, the T1s and 1040s. But you've got to look in private companies, you've got to look at the company to see the generosity of Canadians, because that's where so much donations are happening in Canada, and especially major ones, big donations. And if that's where it's coming from, and if we want the money from there, the more we know about companies, and the more we look at the companies and see where the advantages are, the better we can do in taking money for our charity. Okay, so now we're going to look at the at a first concept out of a company, but we're going to ask the question, how often do you include giving corporately when talking to a donor? In other words, where have you brought up the possibilities of doing so? And we see, look, the results here is that 40 to 45% have actually bring up corporations. That's terrific. And the rest have sort of sometimes, rarely, never type of thing. I'm actually impressed by that figure, and I'm happy for it. And now we're going to try to move that figure up to 95% as we go through the seminar. So we're looking now at some slides, and I'm first going to say these exact slides, of course, they're reproduced under Pear Tree name. I've used this slide 25 years ago. Okay, when I talked about that, I have an accumulation of slides that I want you to sort of look at, see what you're, from the slides from this course, and say, you know what, I want to have a set of slides for myself that I understand and I can present to potential donors. This slide that we're talking, the next 3 or 4 or 6 or 8 slides are taken from 25 years ago. Okay, this is what I would go and talk to people about. Okay, they didn't know what I was, what I was there for or whatever. I'm just to talk about doing philanthropy. Here we're talking about leaving a gift, a legacy gift. Okay, and as we see the slides, we're going to be using a 48% tax rate today. When I use the slide today, it's really 53% in Quebec. We're using interest rates in these calculations, which are old. Doesn't make a difference. It's just an example. But here we're asking the question, if you remember that chart we had about legacy giving, would you give a gift? Would you give a legacy gift? And the answer often is, when we saw if there wasn't children, we said, oh, we have a direction to take with life income plans, child remainder trusts. But if there was tax to pay on death, we knew that there was a potential direction involving estate planning and possibly insurance, okay, as a way of creating a very good gift at a very small cost. So often the question is, and when I'm talking to people, I'm not talking about them. I'm saying, well, when I speak to people, I ask them, like a third person, would you give a gift, a major gift to a legacy gift to charity? And the answer often, I'm telling the prospective donor, the answer I receive almost is, I would give a gift, but I don't want to take away very much from my children and the legacy they're going to be receiving. So I would if it wouldn't take away from the children. Okay, so now we're looking at a slide and we see Mr. A and Mrs. A that owns a company. And again, wealth has this all over the place. And what we do is we say, we want a company, the company, to take out a life insurance policy. And we want them to take out $1 million policy. And we suggest taking out a last to die policy. Last to die is when both Mr. and Mrs. A will pass away. The policy will be longer. We're trying to combine 4 elements here. We're trying to combine a death, okay? Insurance comes in at death. Tax happens at death, the second death, and a will happens. 4 things happen, and we know donations, we've learned, can reduce taxes at death. So we've got these 4 things happening. Normally when you do a tax shelter, you don't know, you can't plan for this. You can't say, you know what, I want to reduce my estate taxes. Pear Tree, can you give me a tax shelter for when I'm going to die? Whenever, how am I going to do that? But here we can create this tax shelter exactly when the tax is going to be exigible. So we take out life insurance, and we're going to take out term to 100 policy. That's a policy that has the same premium year in, year out, to 100. If you live past 100, you don't have to pay any more premiums. So it's a set premium, which is a good policy. and also good for illustrative purposes because it's easy to see what the premiums are. Okay, so the company takes out life insurance policy, will be paying out premiums, not tax deductible. Okay. Mr. A does his will, and it says in his will, I leave everything to Mrs. A. But if she predeceases me, I leave $1 million to charity, and the balance of my estate split 3 ways between my children. Mrs. A's will says, when I pass away, I leave everything to Mr. A. Tax rollover when we do that to the spouses. But if he predeceases me, which means, of course, then she will have the both estates, right? He'll have passed on his estate to her. Then I want to give $1 million to charity, and the rest of the estate split 3 ways among the children. Okay. So we know when that happens, there's going to be a will gift. Ultimately, the will gift will happen, and the trustees will see that. The estate will make $1 million gift to charity. They will elect on their tax return to carry it back to the final tax return and use the $1 million gift against effectively $1 million of taxable income on the final tax return, which again is going to have these deemed dispositions and all the tax to pay. So we're actually looking at taking $1 million of income on which we pay, in this case, $480,000 of tax, and eliminating the tax. So look at the good things we've done. We've given $1 million to charity, and we've saved $480,000 of tax. The bad thing we haven't discussed is we have to pay premiums out of the company. Let's look at the next slide. The next slide just sort of goes through the what we've just said, what I've just said in writing. Let's look at the next slide. So the next slide is a calculation. Okay. And it's an Excel calculation. And what it does is it shows the donor the effect of this style of gift. We know we're going to get $480,000 of tax savings at death. We know the charity is getting $1 million. That's good. We know we have to pay out premiums. Can we put this together in an analysis and see what is the cost of making $1 million gift? Right? I would make a gift, but if the cost to my estate is too much, I wouldn't do it. But let's see what the cost is. So this is actually a real couple from, again, it's very old. It's from maybe at least 25 years old. Okay. And they were in their 80s. Look at the interest rate we're using here, 4.5%. Today we do 3%, maybe 2.5% in our calculations. Premiums today are more expensive. Okay. But let's just look at the illustration. So we've looked at their mortality from the charts, and we see that on a last to die basis, the two of them, the mortality is 12 years. The premium on the term to 100 is $37,200. Okay. We look at the tax savings at death, $480,000, and we make on the right-hand part of the slide, we say, what is the value of that in today's dollars? Well, 12 years is mortality, and at a 4.5% interest, which was the interest back then, the value today of those savings are $283,000. That's savings to the estate, which means to the children. Effectively, they're going to get a third of the estate. Okay, so today's dollars, they will get $283,000. Okay, what is the cost now of the premium? So let's do a chart, Excel chart, very easy to do. We're saying mortality is 12 years, so that's what we're going to assume, is that we're going to pay $37,200 for 12 years, and we're going to look at the present values there. Again, the Excel does this. The first year of payment, $37,200. What's the present value of that? It's $37,200. We're paying it today. The present value is $37,200. Next year, the $37,200. What's the present value? It's $37,200 divided by 1.045%, and then so on, so on, so on as time goes on, and you'll see the present value of all the payments adding up to $354,000. So in today's dollars, The company is out $354,000. And the estate is up in today's dollars, 283,000. Next slide. So, but there's an anomaly there. One is individual saving, and two is corporate savings. So when we have value in a company, we've learned from before, is that we pay tax on that on death, right? If I have a holding company with zero cost base, and I have $5 million of value, I'm deemed to dispose of it. And I have $2.5 million of capital gain, I'm going to pay $1.25 million of tax. So value in a company is not full value, really. You're going to have to pay tax on it. So if in our example, in a present value basis, that company is going to be worth $354,000 less, it also means we're not going to pay tax on $354,000 at death, right? If we, and we've seen some plans, and we'll look at it more, how to reduce the value of holding company in order to not pay tax on death. Well, here we've reduced it, not positively because it's out of pocket. We've reduced it by 354,000 again, present value, which means that we're not going to pay at 48% tax rate on the capital gain, 24% of tax on that. So after tax, the cost to the family of the money is $269,000. That's a little hard to understand, but maybe review that and you'll see that. So here we have two positives. Well, one positive, a present value of 283 in today's dollars to the family, and a negative of 269 to the family. That means that the cost of giving $1 million of charity, it's not a cost, it's a gain of $13,637 on a present value basis. We're richer, $13,637. Okay, now, when I'm talking to the donor, I'm saying, this is estimates. We're doing mortality, we're doing this, we're doing that. But if you ask me the question, can I make a legacy gift of substantial amount of $1 million and not have it cost my family a very substantial amount? If the real numbers in doing this means that the cost is $75,000, not a gain of $13,000, but the $75,000 in present value, because mortality is longer and this is that, things like that, whatever it is, I've achieved my objective. I've now created $1 million gift at a cost of $75,000. So that means the kids, instead of getting bequests of $3 million, will get $2,975,000 each. I've achieved my objective, and I've changed the discussion point with this donor about making a more significant gift. Maybe they'll never do it with insurance, but I brought through the possibility of how to make a legacy gift go from maybe he would have given 100,000 or 200,000 up to $1 million. Okay, I've tried to change the mind thinking that's there and get into it. And at this point, when I'm talking and educating to the donor, I'd say, I don't know if this will work for you. You know, premiums are what they are today, and your ages are different than these people. What's your birthday? It tells me. And what's Ethel's birthday? Okay, you know what I'm going to do? I don't know if this is going to work. I'm going to get a term to 100 quote and just see how it goes. I don't know if this will work for you as well as it does for these people. Let's set an appointment for, let's say about 3 weeks from now. Okay, let's do that now. And I'll come back with you and just see if the numbers work for you or not. Okay. Okay. So again, I've achieved something else here. I've achieved some interest and possibility of making a bigger legacy gift. I've achieved another meeting, because during the meeting, I'm talking about charity. And during the second meeting, I'm going to talk about charity too, and fulfill the, I'm creating relationship. I'm creating more meetings. I'm creating a greater chance for philanthropy. Now, when we actually do this, we may not take a term to 100 policy. When we then show it for the second time to the donor, he says, look, I'm interested in looking at this. Okay, Then I say, who's your insurance person? Let's bring in your insurance person to look at $1 million policy. Maybe you're not going to pick a term to 100. Okay. Maybe there are other policies, and there are other insurance policies which actually have great value. It have to be in the right place at the right time and the right thought process, which may give greater value than even this. But I'm not selling insurance. I'm just saying, let's bring in your insurance person to look at the different ways, and they can probably look at 3 or 4 different types of policies and pick the best one that's there. The other angle that's here is that ultimately, when they pay the $1 million gift, the estate, they're not going to give us $1 million of cash from the insurance proceeds. They're still going to donate marketable securities, because it's always, right, when we talked about bequests, right in there to make sure we don't forget, to the greatest extent possible, make this gift from appreciated marketable securities. Why? Because at the second death, they're going to pay tax on appreciated marketable securities. So why pay tax on that? Pay the gift, the $1 million, out of appreciated marketable securities. If you have personally held appreciated marketable securities and there's $200,000 of gains there, you're going to pay tax on those $200,000 of gains. Donate those shares. You're not going to pay tax on $200,000 of gains, which would ordinarily be about $50,000. You can actually put those into the figures. What's the present value? 12 years, 4.5% of $50,000 of value, and that reduces the cost of giving again. Often we've seen when we've done this, and we often see the net cost of $40,000 or $50,000, is that if the person really has a great portfolio with a lot of long-term holds, that the saving on marketable securities, present valued, even knocks out the $50,000, $60,000 cost to something to $5,000 or zero. There's always more. There's always more thinking and doing more. So I like this plan, not necessarily just because they're going to do it, because it creates interest, it creates a second meeting, they may do it, and that's creating a larger gift. And it's fun, and it's really terrific. Okay, let's go on. Okay, Holdco makes a gift of $500,000 worth of security stakes. So now we're talking about marketable securities out of the company. We've seen this before. Adjusted cost base is $100,000. The capital gain is $400,000. And let me turn off my. And what's the balance here? What's the special thing here? Let's go to the next slide. The special thing, we've seen it before, is that there's a $500,000 gift, $100,000 cost base. Okay. Yes, the $500,000 receipt in the company can save $250,000 of tax. We're not paying tax on the capital gain, but there's $400,000 of CDA created. If you would normally sell the stock and you'd have a $400,000 capital gain, $200,000 would be taxable and $200,000 would be CDA. That's good. This creates an additional $200,000 of CDA. So it's an additional value. I'm not even going to compute $400,000 of CDA value. I'm going to say the additional value, because it's a gift, of $200,000. That's how do you get $200,000 out of the company free of tax? Make a dividend of $320,000 to get $200,000 out. That's saving the company $120,000. So there's a lot of value to a corporate security gift. You're using the receipt against 50% property income. You are not paying tax on the capital gain. There's a saving there. The extra CDA has got tremendous value. All of those values put together can mean, if you've got a low cost base, a gift with a very low cost of giving. So I always say this is my favorite gift because it's so simple. It's not complicated like the one we just saw on insurance and all that type of thing. It's simple and it has great effect. So that's why it's always got to be there when we're talking to people about gifting. It's, oh, marketable securities is a great gift. Do you have a company which has marketable securities? Oh, because if you do, let me show you a few slides about the effect of a marketable security gift in a company. Okay, and you take out your slides and you say, oh, look at this and look at that. Okay. Okay. So let's go on next slide. And remember Dev, we saw him in the first lecture, and we're just reviewing it again. High tech. Now, why did I pick him to show corporate marketable securities? Because his private company went public. There was a tax rollover of his private company shares, his low ACB private company shares into the public company. The shares are worth tremendous amount, but his cost base is low. Where do you find somebody who has really low cost base for public company shares? Sure, if I own BCE since 1972, I have a very low cost base. But if I have my own public company in a sense, and I converted my private company shares to public company, I have also a very low ACB, and therefore the greatest amount of capital dividend account from gifting those shares out of the company. So we saw that with Dev, how, oh, I want to get tax-free dollars out of him, how that gift is so good, and as a way of doing it. Okay, we saw it next slide with June. Okay, we saw before in lecture 1, who has inherited a holding company from her husband. It was worth $5 million. And we saw the plan that said, if I donate marketable securities out, it does 3 things. One, I can use the deduction in the deduction in the company. 2, we're not paying tax on the capital gains. 3, I get capital dividend account. That's a positive, extra. But 4, and this was the concept there, is since that holding company is going to be taxable to June relatively soon, not tomorrow, but relatively soon, she'll pass away in 5 years, 6 years, 7, whatever. I'm also eliminating a value which will be taxed at death. And when I declare that capital dividend account dividend out of the company, that reduces the value of holding company even more. We saw that slide back in session 1. So all of a sudden, we're looking and saying, boy, we're doing a job here reducing the holding company. Maybe we're going to do more marketable securities, or maybe we're going to sell marketable securities in that company, use up a receipt from gifts, get out more capital dividend account. So it's very good. We're going to look at this later on when we're going to look at the gift of private company shares. June actually giving her shares as a gift and maybe marrying it with this. We're going to see even more. Okay. So the next slide just talks about what we did with June. That shows, yes, I'm reducing the value of the holding company by the gift itself, and 2, by the capital dividend account dividend. Okay. Let's look at mining flow-throughs now. So in the next slide, so we've discussed mining flow-throughs to the individual. And, as I said there, the concept of mining flow-throughs is basically a simple, relatively simple, it's not simple. You're buying an investment, you're doing it, you have your tax returns, got all kinds of stuff on it. But, relatively simple, you're buying an investment, it gets sold the next day, and you're out of it. The rest is financial, tax rates and things like that. The charity gets your money. Okay. And what happened to me personally is by utilizing this technique for so many people and just educating people about it, not selling them, if I didn't sell them, educating people about it, is that so many people in our sphere at our foundation that we talked about used us to do their gifts. through mining flow-throughs. And that led to more trust in us, in knowing we're there for them, helping them. And, you know, as I talked about, in the last seminar, you know, where one of your products that you could have in your charity is saying, yeah, you're going to make $40,000 of gift to us because that's your plan. And if you do it through marketable appreciated securities or mining flow-throughs, why don't you do 50,000 and we'll put the 10,000 aside, and when you want to make gifts to other charities, we'll do it for you in your name, so you'll get the low tax rate, low effective tax giving rate, and on all of it. So we use that to create trust in us, and people did many other things with us because of it. Corporate ones have evolved a little bit, because certainly in the beginning there was much more corporate ones done with it. There's fewer now available, and the premise that we want to talk about now is not exploration and getting deductions, or sometimes they're development out of corporations and you get the deduction over a few years, which is fine. Is that the one concept that's different from the individual one is that the value when we're looking at low cost of giving is back to our capital dividend account. Yes, the capital dividend account comes in here as well, and that valuable capital dividend account, because in our, even back when we do it personally, when we donate the securities or we sell the securities, we do both, we dispose of our asset. Our cost base is zero because we've written off the investment through exploration, and therefore we have a capital gain. Okay, that's part of the numbers. We're going to pay tax on the capital gain. 50% is taxable. It's part of the numbers when we work out cost of giving, no problem. But in the company, when we do that and we figure out the tax, we're left with a capital dividend account for 50% of the gain. Okay, and capital dividend account is valuable, right? If we create $50,000 of capital dividend account in the company, wow, that means instead of paying out $80,000 of dividends to the shareholder to get him 50, I can just pay out a $50,000 dividend, saving the company $30,000. So that's the value in the mining flow through corporately. There's other values, but the additional value, which brings the cost of giving down to a low amount, is the capital dividend account, and which creates a little more esoteric thinking about the values here. Well, what if you don't need capital dividend account, whatever reason? Well, then I can't reduce my cost of giving if I get something which is no value to me. So you've got to, when you look at corporate ones, you've got to look a little deeper into it, see the effect of CDA on it, see is there value to it. For example, if someone has already in their company 50 million of capital dividend account, then you might say adding 50,000 of capital dividend account isn't really helping me very much today. So it's a little more thought-provoking looking at it in the company. Always, of course, we're saying you can do it in the company, but it's up to the professionals to look at it for the client. You're not looking at their company and saying, is this valuable for them? You're just saying, you know, there is such thing as companies. Here's my slides on it. You have to look at this and whatever. Bring your professional in to see if it's worthy for you. Okay. So we're going to move on to a next part of the seminar. And I'm going to tell you right on that if there are some new concepts we've seen, we're even going to see some newer, and in some ways, the last one is even more difficult in its complexity. So I'm warning you, but these are good things. And I don't want to not show you, in my experience, what has been good, because that's what I'm trying to do here. I'm trying to pass on my experience to you for the good of charity. Okay. So the next slide, I'm going to show 3 gifting private company shares. And I'm going to show you June, remember, doing preferred shares as part of a plan out of our holding company. I'm going to do something called the super capital gains exemption shares. And then I'm going to do something called the transaction cumulative preferred shares. Okay. And what we're not going to see here is, as we're entering into this new subject of giving private company shares, is gift acceptance policies on it and other data, which you're going to get in the next seminar. The next seminar is a case study. We're going to be giving all kinds of gifts are going to happen, including private company shares. And we're going to show you hard copy. You're going to have through the slides, gift acceptance policy. So you'll have it to play with and to see and to learn. But we're not going to do that today. We don't have the time. It'll be next seminar. Okay. So let's go to the slide, the next slide. Okay. So we've seen June already, and we have already saw that giving marketable securities out of the company and getting capital dividend account has got an additional value of reducing the ultimate estate taxes that she will pay. Okay. So here we're looking at the same June and we're saying there's another way to reduce estate taxes, because she's going to be deemed to dispose of, let's say, her shares in Holdco. What if we just donate the shares of Holdco? Not the securities within. What if we didn't donate the shares of Holdco? What happens then? So it's her donation. The money is going to come from the company, okay? But it's her donation. So here in this example, let's assume she donates $100 of shares to your charity. Okay. What happens? So the first thing is, when you donate a property, you're deemed to dispose of the property, right? So you would have proceeds of disposition of $100, the value of the gift. Your cost base is, we're assuming, $0. So we'd have $100 capital gain. The same thing if we're donating marketable securities. We're deemed to dispose of them. If the cost base is 20 and it's worth 100, we have an $80 capital gain. But for marketable securities, we then have an exemption. We can pull it off the tax return. For private company shares, there's no exemption. If you see the Globe and Mail today, the wonderful Mr. Don Johnson has put an article in, just in today's thing, about telling the government, let's create an exemption for a gift of private company shares and for real estate, which he's been pushing for years now. We actually had it in the legislation, and when the change in government happened, they took it out. Mr. Johnson was one behind getting marketable securities to have the exemption for that. He was a leader, a great Canadian, and he puts his money in investments in trying to do this to help all Canadians. So thank you, Mr. Johnson. Thank you. But we do not have a capital gain exemption on a gift of private company shares. So that means if I gift $100 worth of shares, I get a receipt of 100 and taxable income of 50. Okay, the receipt will knock out the $50 of income, and I'll have $50 receipt left, which will save me $25. Okay, so I've achieved something here. I've achieved a personal saving of $25. And again, in our concept of between the corporation and the individual, I'm putting money in the company, that's value. Because to get June $25 out of the company in a normal way, I'd have to make a dividend of $37. So just by that, I've created value. Okay. What else has happened here? when she passes away, that $100 of shares is not there. She would have paid tax on that of $25. So we have a double dip here in a sense of saving tax personally on $25 because of the receipt, and then saving tax personally at the estate level. And we're using up the corporate assets to do it. The shares get redeemed or bought back immediately after the gift, and $100 goes into the company, sorry, into the charity. Maybe the company will get a dividend refund off that because it's a taxable dividend on the redemption. Government sort of says, sometimes it says, well, if you're redeeming to a charity, we don't give it, but then they recant and they say, I guess it depends on the facts. The Income Tax Act says that when you, under the section on dividend refund, is they can negate a dividend refund if you're doing a donation strategy, and one of the main reasons for doing it is to get a dividend refund. But when we're doing this, it's not one of our main reasons for doing it. It's we're giving a gift, we're doing estate planning, we're giving a gift. That's what our main reason is. If the result is you get a dividend refund, fine. I mean, that's the law, that's the act type of thing, but we're not, doing it. But, there is a bit of uncertainty there. Okay. So there we go. Okay. So now I want to get off the slides totally, bring it back to just to me. Okay. Okay. So what I want, because I don't want you to look at slides, I want you to take a piece of paper and a pen and go through with me June a bit, because I want you to sort of stretch a little bit on here. So here's the facts. There's Holdco worth $2 million. It has refundable dividend tax on hand, that taxes we paid, which are potentially refundable if we have taxable dividends of $200,000. The cost base of the shares are zero. It has at least $1 million of marketable securities. And let's say 600,000 of them have low cost base shares. Let's say 20%, 120,000 cost base. So I'm going to repeat this. Holdco's $2 million, zero cost base. It has refundable RDTOH, refundable dividend tax on hand, potentially refundable to it of $200,000. It has marketable securities of $1 million at least. Within that, it has long-term holds, BCE, whatever it is, of 600,000 with a cost base of 120, 20%. And we're looking at it. And I'm just playing here. Okay. I'm going to make a column for Mrs. A and say values. What values are there for her? Okay. One of the realities is if she does nothing, there'll be tax on that holding company. She'll pay $500,000 of tax at death. Okay. So her annual income outside of anything is $200,000 from RIFs, pensions, and investment income and everything. Okay. So I'm going to combine some of our concepts. So one of them is, let's make a gift of $200,000 of marketable securities of long-term holds. The cost base is $40,000. Okay. And that means there's $160,000 gain. And I'm going to make a column called capital dividend CDA, and I'm going to put $160,000 in that column. There's $160,000 of gain, but we don't pay tax on it. So the company, I'm going to have a column for income for the company, and the company has $50,000 of income in the normal course before all this, $50,000. I'm not adding to that income by the gift because it's not taxable. Okay. Then just playing, I'm going to sell $400,000 of stock, those long-term holds that have an ACB of $80,000. And that's a gain of 320. Okay, 160 is taxable. I'm going to put that in the income column for the for the company, and 160 goes into the CDA column. In fact, I have two CDAs now, from the gift 160 and from the sale 160. That's total $320,000. Okay. So I'm going to take the $320,000, and as we saw before, I'm going to not donate, I'm going to dividend it to Mrs. A. So now she has $320,000 tax-free in her values column. Okay. What's the tax position of the company? We started at $50,000 of income. We have $160,000 of taxable income from the sale. That's 210. But we have a donation receipt of $200,000. We can only use a donation receipt for 75% of income. And that's about $157,500 of it. So I'm actually not utilizing the donation receipt perfectly. Okay, I'm doing a play here. I'm not trying to get the best. Okay. That leaves us with $42,500 of taxable income. Let's assume we're going to pay $21,000 of tax. So now the company's out of pocket $21,000. Okay. Okay. Step 2. She donates her shares of the company to charity. Oh, well, what's the shares worth and all that? Well, it started at 2 million. We made a gift of $200,000. That's down to 1.8 million. We made a capital dividend account of 320. Now it's down to 1460, $1,460,000. We paid 21,000 of tax. So we're down to 1,429,000 or $39,000 of value. Again, I'm not caring about the numbers so much, but I'm giving you them. Okay. So now I'm going to gift that to the charity. Okay. So when we do that, we've seen that we're going to get a receipt of $1,439,000. Let's say $1,440,000, and we're going to get a capital gain of $720,000, like what we saw before. That means that on her personal tax return, she's going to have $720,000 of income, $1,440 of receipts, so we're not going to pay tax on the $720. We're going to have an excess receipt of $720 from the capital gain. We have $200,000 of income, and will for many years. We're going to use the $720 of receipt in the year to the extent possible, and 5 forward years against her income. Remember, she has $200,000 of income. You can use $150,000 of donation against that. So over a 6-year period, we're going to use that excess receipt of $720,000, saving $360,000 of tax. So in the plus column for her, she got a capital dividend account of 320, and she's going to have tax savings, personal tax savings of 360. She's up $680,000. Okay. The charity now has a company with the $1,430,000 in it. It's going to look at the marketable securities in there and say, I don't want to pay tax on that. gift us, the company, they own it, gift us those marketable securities with a gain. Why? To make sure there's no tax on those securities. You get a receipt in the company, but I don't need it. I don't care. Gift it. Okay. So now, or if let's say there's real estate there, gift it to the charity. You can elect when you gift capital property to a charity to do it at its cost base so that you have no gain there. Okay. So somehow I'm going to, any appreciated property there, I'm going to move to the charity by way of gift and either elect at the cost base to be your proceeds of disposition and your receipt, okay, because I don't care about the receipt, and move it out, okay. And let's assume that we have $200,000 of gift out to the charity, and the balance that's there is going to be a winding up dividend to the charities, and we're going to wind up the company. As we do a dividend, we're going to look at the refundable dividend tax on hand of $200,000 and say, let's get it back. We can get back 38% of our dividend. We have much more dividend. Let's get it back. So instead of making a dividend of $1.2 million, it's make a dividend of $1.4 million. Bring in that dividend refund. More money there. So effectively what happens, the charity winds up with the original $200,000 gift that she made of security, the $200,000 gift of when we owned the company, we took it out, and we had $1,254,000 left in the company, but adding the dividend refund, it's $1,454,000. The charity is going to wind up with $1,854,000 of value. Mrs. is going to wind up with $680,000 of values. Okay. And will not pay tax of $500,000 on their final tax return. So if we were entering into a plan with the family to donate $2 million to the charity, we've received $1,854,000 out of this. Mrs. has $680,000 of values out of that. We've sort of done a lot here. And we're almost on our way to $2 million. And how do we figure how to get that dividend out, or that gift out, which may ultimately be another gift of marketable securities, which can be given 7 years from now, or when she can use the receipt again, type of thing. Okay. I've just tried to throw numbers at you and hopefully having you take notes, not that you can follow it all so fast, but to say you could play. And the advisors to Mrs. June can play and look at different things. And as I reported at a seminar a few weeks ago, we've, in the last 2 years at the foundation, have received 3 holding companies as gifts, because it was the best thing, in which we gave personal receipts and a capital gain, which they used tremendously. We would do the transfer of the securities, make sure there's no gains out from company, and try to get the dividend refund out to get the best result possible. So again, as you're dealing with your donors and the allied professionals on this Zoom call, yes, think of these things, but as you're just talking to people about possibilities, people do this, people do that, it's a way of looking at the company. There's wealth in companies. Let's get the money out of those companies. Okay, now back to slides. And the next slide. So what this is that there are, sometimes if you ask the question, do you have shares with high cost base? in your portfolio as a private company, there is shares called super capital gains exemption shares, which were done for purposes of getting an exemption on private company shares that are small, that people are sitting with. So they may have $750,000 of shares with a full cost base. They can't take the money out because they have to pay tax on it as a dividend. So that they can't take that out. But if they donate it and they have a full cost base, they can get a full receipt without a capital gain. So, and then when the shares are redeemed from the company, it could get a dividend refund. So what we see here is, if we ask the question, do you have it? It's a very cash flow positive gift to do. And so I asked the question, do you have super capital gain exemption shares? Now let's go to the next one. Okay, so this is the last thing we're going to cover today. And it's not easy. Okay. So a company is a company that's had a transaction. It's had a big gain. It sold real estate. It's sold a company. It has a big gain. And we're looking at that and saying, could we save tax on that gain? So a company, and we're going to look at $2 million of receipt to save tax. A company pays tax at 50% on its property income. So even if it has a $10 million capital gain, $5 million is taxable, and it'll pay 50% on the $5 million. Can we save on 2 million of that? Can we save $1 million of tax? Okay. So what it does is it takes $2 million and it finds a sister company, a parent company, a subsidiary, and invests $2 million of preferred shares of that company. Okay. Now it's got shares of a company with a $2 million cost base, and it sits there. Okay. The next thing it does is it goes to a public charity, can't be private, and it says, I want to make a gift to you. A says this, the company. Here's my piece of paper that shows I have $2 million of preferred shares of company B. I gift it to you. The charity says, thank you, and says, oh, we got to give you a receipt. It's a private company share, it's not cash. We've got to get an evaluation done, and let's assume the company's auditors will provide evaluation, says, in our opinion, the value of these preferred shares are $2 million. Okay. So the charity issues to a company a $2 million receipt. And therefore it saves tax. Here it shows on the slide, $920,000. Again, this is an old slide, a 25-year-old slide. But if you have 50% bracket in the company, $1 million. What have we done here so far? We've achieved a $920,000 saving and not given up any money. The $2 million is still in BCO, which is reinvested. Can do whatever it wants. It can buy real estate. It could loan the money to a company at interest. It could get the money. It could reinvest. If it's used to earning 7 or 8% on its money annually, it's saying, oh, I'm putting the $2 million away. I'm going to earn 7 or 8% of my money. I've created a tax deduction without giving up any money right now. Okay. But there's a reality here. The reality here is that we will be paying to the charity annual dividends. We're going to see that in a second. But the charity does own these shares, and they're going to have to be redeemed over time. And sometimes some people do this and they say, you know what, I'm going to redeem them over time. I want to make big cash gifts to you. And so over time, I will redeem the $2 million. I'm going to redeem it $400,000 a year over 5 years. Okay, because that's what I want to do. I want to set up scholarships. I want to set up something at the hospital, and I'm going to pay it over 5 years like I would. But I've achieved the donation receipt today, not over 5 years. So, but that's one way to redeem it and to get it done. Other people will just sit with it, and as we'll see, pay annual dividends on those, which is important, and we'll sit with it until a certain period. And they say, well, we have to ultimately redeem it. What if we take an insurance policy out in B or A to ultimately have the cash to redeem the shares? Okay, so let's look at the next slide. So we're looking at the cash flow. So one is the gift of preferred shares, and actually that 2 million should be in italics because it's not really part of the calculation. It's the cash flow on that is zero. Okay. The insurance premiums is I'm paying insurance premiums on 2 million over time. And I've done a calculation here based on life expectancy of 25 years and interest at 4.5%, like I did for the other one. And I showed that the company is out in today's dollars, $402,000 based on the premiums done for that. The tax savings is 920,000 in this example. What's the present value of that? It's 920. We're getting the savings today. That's a flip on the present value. So the net cost for the donor is a negative 402 in today's dollars and a positive 920, $517,118. So a net cost of doing this gift, of ultimately paying off, getting it redeemed by insurance, okay, is $517,000. Also, the insurance on death capital dividend account will go into the company. You don't need it to redeem the shares, but there's value there to the family of getting capital dividend account, which can remove dollars out of the company free of tax instead of paying our capital gains rates. And there's a value on a present value basis here of $218,000. So the finance shows that the doing this gift creates $735,000, a positive value to the family. Okay, let's go to the next slide. Okay, what I haven't told you is that what are these preferred shares? To give them value, the shares have a cumulative dividend. Cumulative dividend is one in which you have to pay to pay dividends to a common shareholder. You have to pay your dividends to these preferred cumulative dividends. You can't pay dividends, so you have to pay cumulative dividends every year. If you don't pay 1 year, it accumulates. If you have 2 million of shares and you have a 4% dividend and you're to pay 80,000, if you don't pay it in year one, okay. But year two, if you want to pay common shareholder dividends, you have to pay 160,000. It accumulates. So there's value to these preferred shares, even on the marketplace. You can buy BMO shares with these dividends and things like that, which gives you sort of like a market value for these shares, which allows your evaluator to say it's worth $2 million. So let's assume, and a market dividend today could be 3%, 3.5%. Let's assume the dividend we choose for these shares are 4%. Okay. So that means that we will pay to the charity 4% on $2 million, $80,000. So all of a sudden we're starting to pay out cash. Perhaps you're paying out cash for the insurance premiums, but we're paying out cash. Well, that's a gift to the charity. That's used by the charity for its thing. Every year it'll get $80,000, and perhaps ultimately at a time it'll get $2 million in to do this. When it pays the dividend to the charity at $80,000, assuming the company earns property income, it gets a dividend refund, right, of 38% of the $80,000. So it'll get back 38% of the cash it's going up. So there's a good circle here. There's a good thing. This really is, if we look at the next slide, this really is, on the next slide. So a transaction, go back. A transaction happens in Holdco. We search for a parent company, subsidiary, sister company. We ensure the lawyer has to get authorized capital. It may not be sitting with cumulative preferred shares at 4%. So get the lawyer to get this authorized capital, easy to do. The Holdco will invest in cumulative preferred of Cisco before the year end. Holdco before the year end, we want to do before the year end, not to pay tax to help on the transaction, donates the preferred to A, you get a valuation, annually pays dividends to A. Pick a percentage. And you're dealing with the donor. And if you want, it could be a 6% dividend. It could be a 5%. What's the annual charity going to be? What's your endowment? Your endowment's going to be the $2 million earning income for charity. What is that rate going to be that's going to create the charity? Because we're doing charity. Okay. Cisco or Holdco can take out insurance. They don't have to. And in death, using those insurance proceeds, if they have done it, to continue the endowment of cash into the charity. Okay. So the next slide, gifting private company shares has an advantage. If you are going to monetize it, which means we're giving these preferred shares and we redeem them, they get a receipt automatically for that. If it's not monetized, like we've just seen, you have to do that in a public charity, not a private foundation. And the donor has to be at arm's length with the charity, cannot be on the board of directors or an officer of the charity. To do this last sort of deal, the family, the donors cannot be on your board of directors to do this. Okay. In our next seminar, we're going to look at all of our plans that we've done through a case study. The slides for the case study is going to be available on the Pear Tree website Thursday or Friday. You'll get a notice to be able to get them because I want you to look through it. We're going to do some of these gifts. As I said, you're going to get gift acceptance policies also. So in other words, we're going to review all of the gifts we've gone through in the 3 seminars, okay, in a way. So we're going to show practical analysis and things like that again. Please look at the slides that you'll see on Thursday or Friday. Of course, you're going to get the slides for the solution and everything in time as well. But please look at it ahead of time. You might look at it, read through just to be familiar with the case. You might actually try pencil and paper to structurally say, what are the possible gifts here? And what have we learned in the last 3 seminars, and see it out and sort of play a little bit, and then we'll do the seminar. So I look forward to next week's, but now I think we're going to look at some questions that Marilyn may have for us.
Yeah, Bobby, great. Thank you. Lots to think about again today. I'm going to take you back in the questions up to the beginning of the slides. So if you could just lend your mind back to what you started with. Question from Nicole, using a discount rate of 2.5%, does using a discount rate of 2.5% change the calculations a lot? Absolutely.
Today, I use 3%. And 2%, it's like, what's the market interest rate? 2.5% is good. I usually, when I try to create the discount rate, I actually, from a theoretical point of view, I say, you can use the Bank of Canada money for the rate of mortality. If the mortality is 30 years, I say, what's the Bank of Canada rate money for 30 years? If the mortality is 5 years, what's the Bank of Canada rate for 5 years? And the rates are low, they're 2.5 and 2.5 and 3. So 2.5% makes a huge difference rather than 4.5%. It's just the difference of 2% over 12 years is 20%, at the final answer type of thing. So it's does make a big difference.
Does change things. And Sylvia asks, do the calculations differ greatly if premiums are paid from an opco versus an investment holdco?
No. Is that Sylvia, my friend Sylvia? And no, I mean, the quotes you're getting are payable if it's an individual holding or a company or whatever. The quotes you're going to get are the quotes type of thing. They're looking at it from a point of view of risk, the insurance company, and mortality and whatever. The quotes are going to be the quotes, whether it's done in a holding company, opco, or individually.
Okay, thank you. And do the marketable securities that you discussed, do those include mutual funds or only individual stocks?
No, mutual funds, which hold marketable securities, is a terrific gift. Now, and gets you the capital gain exemption. What you might find, though, And someone just asked me the question for someone doing a gift to a hospital, and does mutual funds qualify? Is yes, but be careful about your cost base. Because what happens with mutual funds is at the end of the year, you get a slip from the mutual fund company saying, within your fund, there's some tax to pay. There may have been a disposition of shares within the fund, which means there's a gain within the fund. There may have been interest income in the fund. There may have been some dividend income in the fund, which you pay tax on, which is fine. That increases your cost base of the fund. You mean, if you pay tax on it, it increases your cost base. So if you've held mutual funds for a long time, you may say, oh, you know what, when I invested in the fund, it's 100,000. Now it's worth 200,000. But it's possible that you may have 40,000 if you've held of cost base increases over time. So my gain would not be sort of 50% of the value. It may only be 30% of the value. So that's it works, but just be careful on cost basis.
Okay, gotcha. And Deborah asks, since the insurer pays out directly to the owner, how does the marketable securities, how do they fit in here?
The insurance policy gets paid, okay? And that happens. It goes into the company, and the company can bring it out to the estate. The liquidator or trustee, liquidators in Quebec, looks at the will and says, I got to pay $1 million up. It doesn't have to be from the insurance proceeds. They don't have to marry, oh, I received $1 million. Those are the dollars I'm giving. It just makes a gift. Why not make a gift of marketable securities? Okay. So even though the thinking is that I'm paying for my gift with the insurance proceeds, but when you're actually making the gift, use marketable securities, save more tax.
Okay. We have a great question about flow-through shares in particular. Do corporations get all of the deductions on the flow-through share equal to the individuals? There's a thought out there that corporations lose out a little bit and not as valuable if the corporation is making a donation.
Certainly there are differences. Like for example, Quebec doesn't give special deductions within the company. There are differences. Like all the calculations, there is different calculation, but it does get investment tax credit. It does get exploration deduction. It does get development deduction if that's the one. So it gets basically it, but may not get all of them type of thing. Again, when you look at the sheet that the promoter Pear Tree sends out, it'll show you what you get. And at the end of the day, you look at the cost of giving type of thing, and does it work or not? Again, every province that you're in may have a different sheet, right, for your individuals, with different cost of giving and different whatever, depending on your residence and where the deal is. So yes.
Very true. I think this question is in context with flow-through shares as well. What about ultimate minimum tax?
Well, you have alternative minimum tax. So there's a limit to what you can buy in any of this type of stuff. It's usually, certainly for the individual, it comes into play faster than with the corporation, but it does. But the individual is more the issue usually.
Mm-hmm. Mm-hmm. Martin had a suggestion for you. He says, Bobby, the personal donation is also limited to 75% of net income. So he thinks maybe you assumed 100%?
Nope.
Okay.
No. In here, the maximum you can I know when I went through the example, no, I assume you can only use 75% for donation, and if not, you carry forward. So when I went through that example off slides, I said, oh, here you have this big donation because of the gift of shares, but I could use it over 6 years. So I can only use it 75% to the year, but I can use it next year, again, 75% and next year. So yes.
Okay. And Kevin asked the question to one of the examples. On the example of paying insurance premiums by gifting more securities, how can you gift to the charity and get a tax receipt and use that gift to pay premiums if you hold the policy corporately?
No, you
i.e.
can't.
not gift it?
No. The premiums are paid by the company. You've made a decision to do it this way. The premiums are not deductible, and period. It's not, you're not making a gift to the charity until the will. So there's no interaction with the charity until the will. There's no tax deduction for the premiums. Premiums can be deductible in a company if as a finance expense. If sort of the bank requires you to have insurance as a consequence of getting financing, then the premiums there is a finance expense. So if that's your situation where you're taking out the insurance and there's, let's say, out of OPCO, and you get a letter from the bank because you're doing financing with the bank that says, I require you to have the policy, you could say, okay, I'm going to get the policy. I don't really need it for the bank because I'm never going to need it for the bank, but I'm going to use it for my donation planning. And there it might be tax deductible because the bank requires it. But otherwise, it's not deductible.
Okay. And you won't believe this, Bobby, but those are all our questions today. You've obviously given us a lot to think about, and there probably will be some follow-up questions from you. So please, audience, do send them to askbobby@peartreecanada.com, and we look forward to next week. Any closing comments, Bobby?
Just, I know that what we've done in the last 20 minutes and 25 minutes is a little harder, but follow through. We're going to be revisiting all the plans next week. So it'll give you a chance to sort of do it again type of thing. And have a great week.
Wonderful. Thank you, everyone. Goodbye.